Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for another edition of That's Our Two Satoshis Live. Flying solo this week. Nobody from the ARCA team is joining me, so you'll just have me today talking about what's going on in digital assets. As always, we write a blog as well. It goes out every Monday called That's Our Two Satoshis. You can find it on our website at ar.ca/blog. But I'll review that as well as some other things happening in the market today. Before we get started, as always, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. All right, so what's going on here? I mean, last week was bad. You look across the board, digital assets were down 3 to 5%. S&P was down almost 5%. That's the second week in a row down 5%. Gold was down 2%. Oil was down 8%. Credit spreads are widening. Interest rates back to year-to-date highs. Pretty much just negativity across the entire market. And obviously, this was driven by the FOMC meeting where Fed Chairman Powell, after not mincing words at all in Jackson Hole a few weeks ago, came out even more hawkish in his commentary after they raised rates by another 75 basis points. So the big thing, at least from a macro standpoint, was just the Fed dot plots, which is essentially just all 12 Fed governors talk about, as it stands today, where they think rates are going to be in 3 months, 6 months, 12 months, et cetera. And it was much higher and much long lasting with higher rates than maybe the market expected, which led to the big sell-off. What I think is probably the most interesting thing about the FOMC last week, though, is one, that digital assets really have outperformed quite admirably, at least on a beta adjusted basis compared to other asset classes. I don't know if that's a trend, or in my opinion, it's because digital assets tend to be a leading indicator, not a lagging indicator. So I think the sell-off we saw a few weeks ago was actually probably more macro related than it really was Ethereum merge related. But two, I think the other thing that I think is interesting is that we continue to give the Fed so much credit, even though they have been so wrong on everything they've said for the last 10 years. It's really amazing that trillions of dollars change hands and move on these new Fed estimates. When you go back, it was only 2 years ago when the Fed was openly saying we hope to get inflation above 2%. Like, they were failing miserably at their target of getting inflation back above 2%. And then, of course, now we're in 6, 7, 8% range, and they can't get it down. So here you have these unelected officials who are academics at best, can't and admittedly have no control or idea how to get inflation under control. And yet, again, we have trillions of dollars of net worth being sloshed around on their every word. So not the best investing environment. Every single asset class is basically negative year to date now. Even oil is back to unchanged after being up as much as 60% year to date early in the year. But you have gold is down, oil is now flat, bonds having the worst year in history, both corporates as well as govies. Equities obviously down 20 to 35% depending on where you look. So pretty nasty investing environment, but still a lot of slivers of areas within digital assets where you can make money. I mean, even last week you had a couple of big winners from Ripple, which is more tied to events that are playing out in court versus the SEC. You have things like Algorand and Chili's, which have done pretty well, largely because of their partnerships with FIFA and the upcoming World Cup, as well as a handful of others. Like ApeCoin, which has announced staking, and some others. So you're still finding ways to make money in digital assets from the long side, even if overall market conditions are not great. But here's the crux of what we wrote about in this last week was, if you want to be a digital asset investor right now, you have to kind of separate the short term from the long run. The short term right now, there's no question that if you're looking at data, you are thinking that things are bad in digital asset land. There's basically been 4 success stories in digital assets since inception, or at least in terms of blockchain technology. And 3 of those 4 are really struggling right now, right? The first is Bitcoin. And I think we all know Bitcoin's narrative is certainly questioned right now, and who knows what the recovery of value of that narrative is. But certainly Bitcoin was the first and probably most successful blockchain technology. Second would be NFTs. And NFT volumes are now down 97% from the highs earlier this year. So certainly not great. The third would be DeFi. And everything from DEX volumes to lending activity is down 40 to 50% from their highs. So 3 out of 4 real success stories of blockchain are struggling right now. So if you just look at it objectively and say, right now, is the investing environment better today than it was 9 months ago? The answer would be no. The fourth would be the rise of stablecoins, and that one is actually the one that is bucking the trend. Adjusted on-chain volume of stablecoins is at all-time highs, and I think this is for a couple of reasons, right? One is because when there's not a lot of activity going on in the rest of digital assets, that money flocks to stablecoins. But two, the carnage that we're seeing around the world, from last night's fallout of the British pound to a week ago with the yen deteriorating, and weeks before that the euro imploding. As everything weakens against the dollar, those in other countries are flocking to dollar-based assets, and stablecoins is certainly one of those dollar-based assets that's easy to get your hands on. But anyway, outside of stablecoins, there's really not a lot of positive events that are happening within the digital asset space today relative to what we saw 6 months ago and 12 months ago. So you get that out of the way. Say, okay, not great. So why would you invest in this space? Well, one of the reasons you would look at it is to say, okay, there has been a lot of investment dollars put into blockchain technology, right? We've all talked about how much venture money is poured in. But even beyond venture, there's just been a flurry of money coming in from large corporations and public companies, anyone from Google to BlackRock to Morgan Stanley, Samsung, PayPal, Microsoft, Ticketmaster, Wells Fargo, American Express. I mean, you name it, you go down the list. There are big companies investing a lot of money in this technology. And I think that's really important to separate that type of money from the money that's coming from venture. And the reason for that is we've had tremendous organic growth in digital assets, right? All these projects and companies that came out of nowhere and attracted new users. It's been great, right? There's 100 million users on centralized exchanges. Each protocol, layer one protocol, has developed its own users. Like, that's been great. The organic growth is great. But the next leg of growth, in my opinion, is really going to come from porting over existing Web 2 users over to Web 3. And let's stop for a second and think about where we were 20 years ago in the dot-com era, right? If you look at the companies that came out of the dot-com era, Amazon.com, eBay.com, Priceline.com, right? These were infrastructure companies that did not exist prior to the internet, right? The business models themselves only worked because of the internet. And as a result, they called themselves dot-coms, right? They even had .com in their name. You fast forward 10 years later, well, everybody's now a .com, right? Domino's Pizza is now a .com. Disney's a .com. JP Morgan's a .com. I mean, these companies have been around for 50 to 100 years, but they're now .coms as well. And as a result, you never would say somebody is a .com anymore. It's just assumed that everybody's a .com. So what we're getting at is that you went from this sort of infrastructure, internet native company to all of a sudden the internet just being something that was useful for every company. Well, in the same vein, you could basically say that today's digital asset companies and protocols are .cryptos, right? These are companies and projects that would not have existed if not for blockchain technology. Things like Chainlink, Binance, Uniswap, Lido, Chiliz, I mean, you name it. These companies and projects would not have been able to exist without blockchain. They only exist because of blockchain. They are the cryptos. And again, it's been impressive. There's been impressive growth, but it's not anywhere close to the amount of users we're seeing elsewhere. So, for example, Binance has an estimated 28 million daily active users. I mean, that is nothing compared to some of the bigger internet companies in Web 2, like your Twitters with 300 million daily active users, or your Facebooks, or even your traditional brokerage exchanges, your Robinhoods, your E-Trades, et cetera. So how do you get that growth number up? It's probably not going to come from organic growth within crypto. It's going to happen from these partnerships with other companies that existed prior to blockchain technology, in the same way that the internet grew because of those the growth of non-internet native companies. So you look at just in the last couple of weeks alone, you had Starbucks unveiled a platform to allow rewards programs to earn basically NFTs and unlock other NFTs. You had Ticketmaster tapping Flow to issue NFTs for their tickets. You had LG, the consumer electronics company LG, building an NFT marketplace on Hedera. You had KKR, the large private equity firm, announcing that they were going to offer their funds on Avalanche. You had Sweatcoin, which is probably the most interesting. Sweatcoin was a walk-to-earn app in Web 2 land with nearly 100 million active users, and they basically tokenized a part of their business on the Near blockchain, and were able to bring over about 13 million people from their 100 million users to download the app, and many of which who now have Near wallets. So you look at that kind of growth. I mean, think about Sweatcoin just as the last example. There are 100 million users on this app called Sweatcoin. That dwarfs anything that exists in the organic digital asset world. And all you have to do is port it over and create a new Web3 version. And that is immediate usage from new entrants. So, when you look down that list and you think about like, how are we going to make digital asset prices go higher? You got the macro crowd over here saying, you got to have better macro data. That's all that matters. You got the Ethereum merge saying like, this is what matters. It's tokenomics. The reality is onboarding millions of users from Web 2 is probably the next leg of growth. And that's not that far away when you look at all the different partnerships that have been built over the last couple of years. So, look, you look at the data today, you look at the growth today, the organic usage, it's not great. But if you believe that we are in that sort of crypto phase, and pretty soon we're going to be in a new phase where it's just every company has some form of blockchain interface, you could see a world where the numbers that we're looking at today in terms of daily active users and wallets is just peanuts compared to where we're headed. So that's the semi medium to longer term bullish view. And at the end of the day, none of that is going to be affected by whether or not interest rates make it to 4% or 4.5%. So we all love to talk macro. Sure, Powell tells a good story, and it definitely drives prices for a couple of days here and there. But the longer term story is still intact here, and I think that's where my attention as an investor is starting to move to. So that's it for this week. I really encourage you to read the blog. Judging by the engagement I've gotten so far on Twitter, this wasn't a topic anybody cares about, or maybe they just didn't see it. But I think cryptos are the new .coms, and we should think about it in that term. So that's it for That's Our Two Satoshis Live. Thanks again, everyone, for joining us, and we'll see you again next week. Lashana Tova. Happy New Year to anyone celebrating.